China, the largest automobile market globally, is often portrayed as poised to dominate the electric vehicle industry. However, this narrative diverges significantly from reality. Contrary to popular belief, many EV companies in China are facing financial collapse, with over 400 such companies already gone into liquidation. Abandoned electric cars litter fields across the nation, symbolizing the industry's struggles. In delving deeper, we uncover the reasons behind the staggering bankruptcy rate of 90% among Chinese EV manufacturers. China embraced the EV trend early on, evident from the proliferation of EV makers in 2018, with as many as 487 operating in the country. This surge was fueled by a clear directive from the national government, signaling its ambition for China to lead in electric vehicle technology. Local governments also eagerly supported this initiative, investing in numerous small EV companies. The strategic vision outlined in 2010 identified new energy vehicles as a critical sector, comprising pure electric, hybrid, plug-in hybrid, and fuel cell vehicles. Although initially diverse, support gradually shifted towards fully electric cars. To bolster the industry, the Chinese government implemented various supportive measures, including subsidies, tax breaks, and procurement contracts. This support framework spurred the emergence of homegrown EV brands, dedicated to refining technologies tailored to Chinese consumers' practical needs. Consequently, a growing cohort of young car buyers became increasingly interested in electric vehicles. The Chinese government's investment in EV-related technologies dates back to 2001, with EV technology recognized as a priority science research project in the country's 5-year plan. This long-standing commitment underscores China's strategic focus on advancing its EV industry as a cornerstone of its economic development agenda. In 2007, the education industry received a significant boost with the appointment of Huan Gang as China's Minister of Science and Technology. Huan, an accomplished automotive engineer with a decade of experience at Audi in Germany, had a strong interest in electric vehicles. He personally tested Tesla's first EV model, the Roadster, shortly after its release in 2008. Many attribute Huan with the crucial decision to fully embrace electric vehicles on a national scale. Despite a promising start with 487 companies, only one remains profitable today. Recent statistics show that only 40 are still in operation, indicating that 447 have gone bankrupt. Among the 40 operational companies, only BYD is currently profitable from EV sales. While other companies may eventually succeed, making profits from EV sales is notoriously challenging. Tesla and BYD are notable exceptions in terms of profitability. However, there's a substantial gap in operating profit margins between these Chinese companies and Tesla, ranging from 14% to 74%. Despite BYD's impressive sales growth, the company struggles with modest profit margins significantly lower than Tesla's. For instance, from 2019 to 2022, BYD's gross profit margins fluctuated between 16.3% and 19.4%, while Tesla's ranged from 16.6% to 26.4%. The difference in cash flow between these Chinese companies and Tesla amounts to billions of dollars, highlighting BYD's need for improvement. Many Chinese companies face disruptions in their capital chains, particularly in recent years. Emerging car manufacturers like Capital, Highways, Leap Motor, and Future Mobility encounter significant challenges in sustaining operations and competing in the market. A significant contributing factor to these challenges is the shortage of capital. Despite establishing production bases and obtaining vehicle manufacturing qualifications, many companies find themselves restricted by insufficient funds for product development and expansion. This capital shortfall can impede maintaining high product quality standards and competitiveness in the market, leading to decreased sales and increased financial losses. Companies like Highways, Weltmeister, and Cytec have faced poor sales due to issues regarding product quality and competitiveness, adversely affecting their financial performance and long-term viability. Although Cytec managed to raise $500 million in funding in 2021, such capital injections may not suffice, given the fiercely competitive and capital-intensive nature of the electric vehicle industry today. Additionally, transitioning from manufacturing small electric vehicles to high-end ones poses another significant challenge for small companies in the Chinese EV sector. This shift often demands substantial capital investment to develop advanced technologies, upscale production capabilities, and establish a brand presence in the high-end market segment. Despite attempts by some companies to make this transition, the sales performance of newly introduced high-end models often falls short of expectations, resulting in significant financial losses. Leapmotor and Skywell Auto are examples of companies facing this issue. Despite aiming for a larger market share by targeting the high-end segment, the sales performance of their high-end electric vehicles failed to meet expectations. Another challenge encountered by certain companies in the Chinese EV industry is limited vehicle deliveries. Hosen Auto, for instance, has struggled to deliver its vehicles to customers, with only 900 units successfully delivered so far. In an EV market where monthly delivery volumes often reach tens of thousands, such low delivery figures can erode consumer confidence in the company's ability to effectively meet customer demand. This could result in a diminished presence in the market, tarnished brand reputation, and challenges in attracting new customers. Limited vehicle deliveries may stem from various factors such as production constraints, supply chain issues, and logistical challenges. Insufficient production capacities, bottlenecks in manufacturing processes, or inadequate distribution networks can all contribute to this limitation. Moreover, traditional Chinese car manufacturers like Great Wall Motors, Geely Auto, Future Outlook, and GAC Group are experiencing substantial growth in their new energy vehicle sales. This trend not only mirrors the shift in consumer preferences towards electric vehicles, but also intensifies the competition for emerging companies in the Chinese EV market. Despite the hurdles faced by some Chinese EV manufacturers, the overall growth trajectory of the Chinese automotive industry is anticipated to remain strong in the foreseeable future. Several factors bolster this optimistic outlook, including robust domestic demand, technological advancements, and an expanding global market share. China's large domestic market, burgeoning population, and rising disposable income continue to propel vehicle demand as consumers prioritize environmental consciousness and seek sustainable transportation options. The demand for new energy vehicles, including electric vehicles, is projected to soar. China's commitment to research and development is poised to significantly impact the automotive industry, particularly in electric vehicles and autonomous driving technologies. With an expected research and development spending of 2.8% of its GDP by 2025, a substantial portion of this investment is likely to be channeled into automotive advancements. This heightened emphasis on research and development will foster the development of cutting-edge technologies, reinforcing China's position as a global leader in electric vehicles and autonomous driving. In the Middle East, Chinese car manufacturers are strategically positioning themselves to expand their footprint and increase their market share. The region's automotive market is forecasted to grow at a compound annual rate of 5.2% between 2021 and 2026, as indicated by the latest automotive report. This growth presents abundant opportunities for Chinese automakers to bolster their sales and influence in the Middle East. As the region transitions towards electric vehicles and renewable energy, Chinese automakers proficient in EV technology stand to gain significantly. Leveraging their expertise in manufacturing electric vehicles and advancements in battery technology, Chinese automakers are well equipped to meet the evolving preferences of Middle Eastern consumers. What are your thoughts on this news? Do you think China will be the indisputable king of the electric vehicle industry? Why?